Okay, welcome to Basics. Call instead of stock. This is a relatively remedial position that can get really complicated and a lot of fun things you can do with it once you understand how the position and strategy works. We actually, in our podcast, started out with a little trade in Sophie, and one of the determining factors that got us started into it is that Kathy Woods, who is a big hedge fund manager, went out and bought 1.9 million shares of the stock as it was falling on Monday. It's a pretty big position. Now, what you see is the stock was falling, and then she came in and ran in and bought 1.9 million shares of the stock. We decided to piggyback off of this and get long the stock as well. But instead of buying the shares for 870, 850, it was all over the place. We decided to use a call instead of buying the stock. A, to save money, and B, to reduce risk. Now, the way we teach doing a call instead of stock is we will buy an in the money call so that it has a high delta. We want something at least 85 deltas so that it mimics the stock. If the stock goes up $1, this option should go up at least 85 cents. And eventually, as time wears down or gamma kicks in, it'll get to 100 deltas, just like the stock. And every dollar the stock moves up or down, the call will move up or down $1. You see that we did hit a ceiling on this stock at around 9.25. It kind of goosed above it, got up to 9.45 in the last 30 days, but it really kept hitting its head on 9.25. Now the thinking is real simple. If the market breaks through that resistance, there's nothing stopping it from really taking off like a rocket. And so that's one of the reasons why I chose Sophie. We went out and we bought one contract because it's just for demonstration purposes of the 7 strike call. We paid 206 for it. At the time, it was an 85 delta. You can see at the bottom in the green line the value of the call at expiration, and you also see how far it was in the money. We bought the 7 strike call when the stock was about 8.5, 8.25. It was all over the place. The blue line is what it would be like if we bought the stock at $8. You see that eventually the blue line and the green line from the call are parallel. So the call does act like stock. Okay, and we're going to be having a podcast on a call instead of stock in the next month or so to go into a lot of detail about how to pick the correct strike, the correct expiration, etc. Because every single stock has a different volatility, has different pricing, has different characteristics that make us want to go further out in time in some names and shorter in time in others. Well, we do have a lot of money invested in that call, and so we decided to hedge it by buying the 8.5 put. Now, this put was at the money, and the two combined, the call and the put combined equaled $2.07. What those positions look like combined is this graph right here. Okay, and then I went out and bought some more at 204. Some people got filled at better prices, etc. But when you look at this graph, you can see where the 7 call strike kicks in and where the 8.5 put strike kicks in. Now, when you look at the two positions combined, it looks like a strangle, an option strangle where you're buying the out of the money call and then an out of the money put. Except for this is different. Normally, when we're buying a strangle, we'll buy a call that's a higher strike than the put. Here, we're actually buying a lower strike call than the put, and that's why they call this guts or mambo combo. Okay, what came next is what caused a little bit of confusion, and it starts going into the advanced aspects of a call instead of stock that we're going to be playing over the next 6 months. and it can become much more versatile and fun to play with a lot less risk than a collar on actual stock. And so we went into my toolbox of toys to play with it. And as the stock started to fall, the next day the stock fell. I had expected and hoped it bounced and went through that green resistance line. Instead, we fell and we got down to 705. And the first thing we did when we got down to 705 is I decided to sell the 7 strike put, because if you look at this graph, you see that we are long the 7 strike put synthetically by being long the 7 strike call and the 8.5 put. This is a synthetic long 7 put. So why not sell out that 7 put, whether it's real or synthetic, get the 56 cents we got invested in the trade back, and as the stock moves lower, that put is going to become worth more and eventually fill at 56 cents. I think it only got up to about 50 cents. That's the highest I saw it get to, and we weren't filled. But why not sell the put out to get the back the total risk of 56 cents a share that we have in the trade? If we were filled, what would it look like? Selling that put out at 56 cents will change the graph to look like this. We know that the graph is going to go higher up towards the 0 line because the 56 cents is coming back. The synthetic put is gone because we're selling a real put. And now we're going to be long the 8.5 call synthetically for free. The problem here is that for this to happen, the stock fell. Now we're long the 8.5 call, but the stock is at 705. It almost seems like that 8.5 call is futile. The odds that we're going to go above 8.5 when we kept hitting our head at 8.25 is pretty remote. So we went and we're looking for a fix, and we came up with this. If we had sold the put at 56 cents, we were going to go and buy the 7.5, 8.5 call spread for a quarter. We actually had the order in one of the days. That blue line represents the long 7.5, 8.5 call spread for a quarter of $1 that we could have filled one day. We didn't put it in, but had we been filled, what does it do? It essentially just moves that 8.5 strike call that we have on synthetically down to the 7.5 strike. When you combine the synthetic long call in the real call spread, we're left with the call magically moving from the 8.5 strike to the 7.5 strike. It's a beautiful thing. It costs us 25 cents. Now let's compare the original call instead of stock to the call instead of stock that we started playing with by selling puts and buying call spreads and stuff, and you decide for yourself what you prefer. The top graph is the original trade, where we have the call instead of stock and the 8.5 put as a hedge. The bottom one is the same thing as the top, but we sold out the 7 put and bought the 7.5, 8.5 call spread for a quarter. You can tell by looking at that blue vertical line that intersects the $7.5 price on the chart that the bottom graph call starts kicking in and making money at 7.5, whereas the original trade we didn't start making money to 8.5, and that's represented by the red line. Now, to recap this trade, we were wrong when the stock was at 8.25 and had a risk of 56 cents. From there, the market went the wrong way. It went down, not up as we'd suspected. That happened. So it went down to 705, which is down 15.2% in a couple days. Instead of losing, we turned the trade into a free long 8.5 call. That's the magic, guys. You buy a call, the market falls 15%, and we break even and have a free call. It's got to be a lot better of a strategy than some of you guys are doing right now. Yes, the call's far away, probably not going to be worth anything, but we didn't lose anything. But because it's so far away, and if you love the stack at 8.25, you got to love it at 7, right? Maybe that fall was just fear, and it'll recover the next day. If I want to buy the stack at 8, you got to love it at 7. So let's move it down to by buying the 7.5, 8.5 call spread for a quarter. And now we're long the 7.5 call synthetically, and our risk is 25 cents. When the original risk we had into the trade was 56 cents, more than twice that. A much better trade. Let us know what you think and anything else you want to see in the basics class. Thanks.